One of the most important things to learn is understanding price bars. How is price represented graphically, visually, so you can a chart, so you can start identifying and you can start using it and start using indicators to make decisions. And you think of that concept of a picture is worth 1,000 words. Well, that's the idea where price bars are going to represent things as far as what's happening with an individual security. And there's several different types of price bars. We're going to learn about them all, but they're the key building block, and some are real powerful, like a candlestick bar. We have a whole section just for candlesticks because they're such a powerful way of representing things in a price bar. But as basic foundational, price bar, to represent price at the basic core level, and the key one to kind of start with and then kind of grow from there are what are called OHLC price bars, or they stand for open, high, low, and close. Pretty simple. So if we look at, let's say, this price bar on this, graphic here, you can see on the left is the prices going up and down in time, going from left to right. Farther back in time is left, more recent time is to the right as prices go across. You'd see that represented on a chart. But if we think of price just in the price bar aspect, you can see this like straight line up and down, and it's got two tick marks, one on the left and one on the right. Not sure how that visually came across to the camera, but you can kind of see on the idea that there's one on the left and one on the right and one in the middle here. And basically, if we were looking at this particular price bar, or any price bar, you can see that it has a high and a low. That's its trading range. So let's say if this was a daily price bar, or a daily OH, open, high, low, close. So for the day, we can see that the prices fluctuate between a low and a high. Now we can also see from this price bar, it tells us even more information. We can see what the price was at opening. When the markets opened and they rang the bell and the markets opened, people could start trading. This was the first or opening price. You can see where that tick mark bar is on the left there. And you can see in this, it might be a little bit closer to the low. In this example, it doesn't have to be, but in this example it is. And then it trades through the day in the high and the low, and then on the right you see another tick bar. That's the closing price. That's what it ended up at the end of the day. So that was the last price that was traded at in that trading day. We can look at that high and low. The difference between the high and the low, by the way, is the trading range, the range of prices. So prices didn't go above the high, prices didn't go below the low. They're within that trading range there. So that you can see with the name of it, open, high, low, close, pretty simple, right? So if we look a little bit closer at that, if we see, an opening, it's above the previous day's close, that might be an indicator that maybe a price increase is coming, that we want our security prices to rise, right? If we're buying, we want them to rise. So if they are opening, before, above a previous day's close, that can be an indicator that prices might be rising. The opposite of that would be if it goes below, the previous day close, that maybe a price decrease is coming. Now, I wouldn't trade just on that. We want to have a lot more than that, but that's the general idea as far as, looking at an opening versus a closing. But a lot of people don't put a lot of stock in openings, I will tell you. Whether you put more emphasis on the closing price, that's more important. That's the most important. It's really kind of a summary of the trader sentiment for the day, right? It could open at anything, but at the end of the day, after we had this highs and lows in this whole trading range, at some point there was trader sentiment and it closed. The last price of the day was the closing price, and that was where the trader sentiment had. And that's where a lot of people will buy and sell right towards the end of the day to close positions or kind of lock in where they want to be. And they're deciding, do I want to hold this security overnight? Or which might be yes, which might be a good positive sign, or am I selling it more and driving that closing price down? Because no, I don't want to hold it overnight because I don't believe in it as much or whatever. So that it's in a real microcosm of just a day, you can kind of get this feel for what sentiment might be within that daily thing. And then whatever it opens up the next day, well, that's an opening at that point, but you can get a good feel for the closing prices. And that's why when a lot of people are looking at prices and trends, they're really looking at closing prices as far as using mathematics or some of the things we'll learn about when we're looking at averages and stuff. They'll typically use a closing number versus, let's say, an opening number. If the close is, let's say, now we want to see, well, how can we use this in a simple price bar? If the close is higher than yesterday's close, so it closed here yesterday, and today it closed at this, and then what might be happening for tomorrow? If they're closing higher day after day, that means there's more demand for that particular security, and people are willing to pay higher prices for it. So that's pushing the security up, and that would indicate really kind of a good buying trend, right? Because the closes keep going high. So it's a strong buying signal as the close is the high of the day. If the actual peak of the day is the actual close, it comes real close to that high of the day in the trading range. That means that people are really buying at the peak right up to the last minute, and they want to carry it overnight. So they're really like, I want to get in and I want to buy up there. So that can be a real strong indicator when you have your close near the high of the day in that trading range. If the close is lower than yesterday's close, kind of the same thing, but the opposite. Day after day, less demand, and people are willing to sell, and they're willing to sell at lower prices. You have more of a selling trend versus a buying trend. So you can look at those closes as far as looking at trends, and we'll be learning how to draw chart lines and trend lines and all sorts of stuff so we can kind of graphically represent this. But that concept of higher highs is good as far as buying, and lower lows might indicate selling. And that can be, represented here with like different sentiments. Like, if you have, let's say, the price bar on the left, that might be considered a bearish or a downward type of sentiment where we have our normal high-low range. But you can see how the opening opened up pretty high, but then the closing was way down more towards the low part of the range, and the close was below the opening. That would be a bearish or a sales sign in a single day price, looking at price. But if you look at the one on the right, you can see where it opened lower and it closed up higher, right? So that could be more of a bullish thing. And actually, if you were looking at more tick bars, it'd probably represent bullish would be more of a black line or green line versus red line. But you get the idea here where it opens lower and closes higher is the idea of something that would be bullish looking at opening and closes. Now, the daily open, high, lows, close, you also want to consider that high and the low too. What was the highest trade of the day? What was the highest price of that trade, in effect? And the relationship to the previous day's close and high is important as well when you're looking at a series of prices over, let's say, a chart. Same thing, the lowest trade is the lowest trade, or the low is the lowest trade of the day. And you're looking at that relationship to other bar parts like the opening in particular, or a lower open may mean that they may be factoring in new stuff, or trending lower. So you're looking at that range of price bars. So the pricing, price bar can tell you quite a bit, and that trading range can tell you quite a bit too. How big is the difference between that high and low bars? Is it a real short, difference between the high and low, or is it a really long, vertical line going up? And there's a wide range of prices that things are being told at. So you want to compare that in relation to maybe other price bars that are preceding it. And you can start seeing that if there's a small range in the sea of larger ranges, where all of a sudden the price bar you're looking at for the most current day or most recent day or time period, whatever that is, you can see that, well, it would be a day, you can see that, maybe the ranges are getting smaller, then there might be some indecisiveness happening. They're trying to figure out, do we go higher, do we go lower, looking at that trading range. Same thing if the range is large in the sea of smaller ranges, all of a sudden everything's going small, 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 as far as a high and low range, all of a sudden starts to get really big. That, big wide range, that might tell us that an event or something is happening. People are trading more actively. There's a lot more interest in this particular security. So something might be changing. It could be going up higher, it could be going up lower, but it's an indication with trading range that something might be happening. And you can also link that to the volume, how much trading is going on too, because trading range is just looking at the price, where volume's looking at the actual number of actual trades happening. And then together they can give you some good indications. Let's look at some classic trend formations with these price bars and a series of price bars that you'll be seeing all the time when you're trading and looking at things. And if you're taking notes, I think that's very helpful, very good. There's going to be two things in here that I'm going to mention that it might be worth a note on, and I'll tell you when I share them with you, so you don't have to try to guess at that. I'll tell you this might be a good thing to take a note on. But there's two big overriding concepts that are coming up that I think are very important. So if we look at classic trend formation with price bar series, so we're looking at price bars, open, high, low, close, and all that, and they have a series of price bars over a period of time, right? So if we look at a series, or if you're looking at a series, and they tend to be, let's say, uptrending. So the highs are higher. You have higher highs. So each day, the high is getting higher than the day before. And that gives you some additional confirmation that it might be, basically, an uptrend, or an additional confirmation if the lows are also higher too. So your highs are higher and your lows are higher, everything's higher and prices are going higher, that can give you a signal of a strong uptrend. And if you feel that trend's going to continue, you might want to buy in and enjoy, that uptrend and ride that uptrend until it's time to sell. And you can enjoy a price increase and profit from that. By the same token, a downtrend would be lower lows, right? You're looking at the lows and are they going lower? So is the low today lower than yesterday or lower over the past few days, and looking at that trend? And again, if the highs are actually lower, the high of the day keeps trending lower, then that's a stronger confirmation indication too that everything's going lower. It's rarely that perfect. Sometimes you have ups and downs and all that and pullbacks and things, but you're going to be looking for this overall trend, where things are happening. And one of the key things, and this would be the first thing that maybe take a note on, is you want to wait for the trend to develop. Where people really struggle is they might think, oh, I think a trend's developing, but they haven't really proven it yet, or they haven't really shown that from a technical analysis standpoint. You need to let the trend develop a little bit, and so that's a real trend and not just kind of a fake where it's going to go the opposite way you want. So way to lose money in technical analysis to kind of guess at things before they've actually developed. You want to let things develop. You want to have trends develop. So that's a key note to take away, is let the trend develop. And we'll learn how to draw trend lines and things. We have a whole section on chart patterns. But right now, higher highs are upward trends, lower lows are downward trends is a classic way to look at that. And you can see that kind of graphically here too, as well. So if you see on the left here, the uptrend, you see how the tick marks on the right-hand side, the closing prices, you see how on the right-hand closing prices, they're always going from each price bar, each up and down price bar, how they keep going on the right-hand side, keep going up. That's showing a definite uptrend because they keep going up. In fact, even the lows look like in this here, let me double check. Yeah, it looks like the lows are going up too. So this is a strong uptrend where the higher highs are higher and the lows are actually going higher than the previous day too. Again, left to right over time. Same thing with the downtrend, left to right, further time would be in the back. You can see how the lower lows on the right-hand side, how the prices are getting lower each time. Just a little bit, but so it's not a super strong one, but you can see the right on each individual vertical bar, how that represents a day and how each little tick mark on the right gets a little bit lower each day, showing that there's a downward trend. That part that I just showed you an example, I actually pulled from a real chart. And I highlighted that here with little green dashes, and you can see how, if you were trading this, you could see, on the far left of where the green starts, where the green highlight part is, actually going all the way left. If you go all the way left, you can see how the price bars were kind of up and down, right? Kind of, there's no definite trend. They're up and down, right? Outside the green area to the left. And then they start to turn going upward, those black bars going upward, and that's what we were showing, the higher highs. And then it reversed, and the trend went to those three price bars where it went lower, and you had a little mini trend there of lower lows, and it started trending the other way. And then if you go beyond that, beyond the green box, you can see it went up for a day, and then down for a day, and then started kind of going, sideways a little bit, up and down, and then you can kind of go on from there as far as some significant price moves both up and down. But if you look inside the green box, you can definitely see a strong upward trend, and for a short period, a downward trend there just based off price bars. The second thing I think you'd want to take a note on, by the way, is not only wait for the trend to develop, but also understand that the trend is your friend. Probably the most classic thing that's ever said in technical analysis is the trend is your friend. You'll see that come up every while. Because the idea of the trend is this gives you some prediction capability. When you have those strong uptrends, you can kind of predict that will continue, and you can kind of identify when that trend might be over. So the trend is your friend. Look for trends. You want to be friendly with trends for sure. And that's the key part of a lot of technical analysis, is identifying trends and making decisions around that. So remember, the trend is your friend, but also you got to let your friend develop. So let your trend become clear and develop, and we'll be showing you how to do that up in upcoming lessons. If you've started playing around or looking at like charts and things like that, you've probably noticed spikes, right? Where you see this high-low range all of a sudden is noticeably different than the others, right? It just spikes up or it spikes down. Something's happened, right? And it really, is a dramatic thing compared to the other price bars that are preceding it. And it kind of gets your attention because it's just dramatic, right? It spikes out there. Something has happened with the price where the range has gotten really broad, really fast, all within a day, let's say on a daily price bar. And you want to ask yourself, when you see spikes, is it true? Is it a true reversal? Has something really dramatic happened? There's a big event. Something has happened that is going to cause that security to trend in a different way. Is there a reversal coming around? It's going to just something dramatic has happened, or is it something that's more temporary, like a panic or a rumor that came out that's going to correct maybe in the next day or so? Where it's like this big spike, and then everybody's like, much ado about nothing, right? So those are the kind of questions when you're looking at spikes and when you're applying your technical analysis to a spike. Is it true or is it not true? And you can see them on a chart. Like, let's look at our chart again here, and you can see this big red spike to the right, right? So you can see that this big red spike. And what do we know from learning about our price bars? We can see that it opened on that particular red spike there. It opened up pretty high. In fact, it opened up much higher than the day before. You look at that black bar right preceding it, you can see where the close was, and all of a sudden, the price spiked way up, right? But then why is the bar red, indicating it was a down day, when it spiked way up? Well, what happened is it got way up there, something where people are anticipating something or something was going on. All of a sudden, traders figured out, oh my gosh, this is not good news. This is actually really bad news. So then it went spiking all the way down. And that's where you can see where the closing is on that red bar to the right, where that's the closing price is well below the previous days, the previous days open and close. So it opened real high, something was going on, people are trading it real high, and all of a sudden, boom, and went way down. And I'm not sure why, but this is a great example of this particular one where it went way down and closed way down. Also, you notice that the volume bar, the bar on the kind of the bar on the bottom, all of a sudden also spiked up too. So our volume increased. There was a lot of trading activity. Remember, as we know, if there's a lot of volume, that can be more of a confirming event that something real might be going on. And usually when you see spikes, you're going to see, that horizontal bar get, pretty high because something's happened and causing a lot of things, a lot of action on that particular security. Now, what we'll want to do is to figure out, what's happening here, and do we want to invest in it? Now, maybe there's some news, and we say we believe in the news, and so we're buying or selling based just on that news. But if we were looking at technical analysis and we're looking at trends, we might say, this is really getting wild here with this spike. It definitely closed down. I might want to be watching early the next day with the opening. Where does it open the next day, and what might be going on, so I can see if there's a trend, going on. It looked like previous to that there was somewhat of an uptrend, going, definitely at least for a couple of days, it was going up as far as, going up. Actually, 3 days in a row it went up, but then it went way down at the end after a big jump up. So that's a spike. That's what a spike might look like. And then if we look at it, like, well, what did in fact happen with this? This is real stuff that really happened. And when we look at that, we can see like, oh, the bars turn black, so that means their prices are going up. There's prices going down in the red. Volume went down, but you can see after it closed way down in the red bar, or red price bar, it opened just a little bit higher, and then through the trading day, it had a more normal or narrower trading range and closed up higher, actually significantly higher. And then it looks like it started a little bit of an uptrend. You can see the closing bars or the tick marks on the right. Then following day it went up a little bit, then up a little bit more, and then up again. So, something happened to cause a reversal for one day in that previous trend, but it looks like it got back on an upward trend. So, that's how we could evaluate that spike. Now, if it went the opposite way, the spike could have proven to be true as far as trend reversal, and we're now going to have a big downtrend. And if we just expanded it further, going back in time, you can see that big red spike in the middle. We had our little uptrend. And then what happening is we then went into a downtrend. But all these things that are happening, we would have been using our technical indicators to identify when these trends are forming and when they're not forming and when there might be reversals. So we're getting in and out at the appropriate times is the idea behind this. But be aware of spikes because, there's something that's really dramatic, something dramatically is happening. Let's talk a little bit more about how we can use the trading range as a technical analysis tool when we're evaluating what might be going on here. And as we know, the range is the distance between the low and the high of a price. And we learn how we can identify spikes where there's these broad ranges in terms of the high and low, but there's other ways that we can use trading ranges as well. So let's look at some of those and kind of have an understanding of it. And it can be a leading indicator as far as a price change that is coming. And when we start seeing these ranges between high and low, there might be kind of something's coming. That's why we call a leading indicator versus something that's maybe more of a lagging indicator. So it can be very helpful that way as well. So if we look at trading ranges, you can look at range expansion and range contraction. So if we look at these examples here on the left, we have range expansion. You can see that the price bars, just that middle part, if we're looking at that range, are lengthening over time. You can look from going from left to right, how they tend to be lengthening. And that would suggest a continuation pattern as far as, if it's expanding, that whichever way it's going, it could be up or it could be down, could be, continuing to go in that pattern or continuation. If we look at a range contraction, that's where the price bars are shortening over time. And you can see from the left to the right on the right-hand image there, how the bars are getting much, much shorter. And that suggests a trend reversal may be coming up soon too. So if we, as well as using these other indicators, we're going to learn all through the course, you start looking at range expansion, range contraction versus a continuation or a trend reversal might be being indicated by the patterns within the price bar themselves as far as what may be going on here. So range expansion and contraction don't tell us anything about the existing direction of the price move, just more so whether it would continue a continuation pattern or that trend might reverse, because it could go either way depending on whether they're contracting or expanding. But the range can expand or contract in both upwards and downtrends, so they can do it both ways, but it's more of range expansion is a continuation pattern, going to keep going in the same direction, and a range contraction might show a trend reversal or basically, flattening out or changing the trend is the big idea behind that. In addition to looking at trading ranges and how they could be indicating a continuation of a trend or the reversal of a trend, there are additional ways that we can kind of add confirmation to that. So let's take a look at some of these important ways that we can do that. A very important thing to look at is volume. And volume could be either rising or shrinking. And volume basically is looking how many transactions, how many trades are happening. Is that going up or is that going down? So if volume is rising, as in more people are trading the stock, or maybe existing traders are just adding to their allocation, right? So it's not necessarily new people coming in, it might be existing people, buying more. That tends to accompany a range expansion and really accelerates a trend, which whether it's going up or down, the trend could be going up or down, but as volume rises, that will tend to keep the trend going in that direction and really expand on it. If you happen to see an expansion of a range, wider range, but it lacks in volume, then that could be a mystery and you need to look at kind of other indicators where it's kind of giving a false signal here a little bit. So you could look at indicators like in our momentum section of the course to use to kind of confirm what be going on. But the idea is if it's rising, it's going to look at an expansion or accelerating the trend. Now, if volume is shrinking, which means fewer people are in the market for this particular security, or existing traders are reducing their allocation, they're now getting out of it. Falling off volume often accompanies a range contraction where the width between the range, the height and the high and low might be contracting and might be associated with falling volume when you're looking at a trading range, a range of prices. Another thing you can kind of look at is looking in terms of trading range and getting some indicators and confirmations is around the open and close position. There's really four combinations. You can have an expanding range, the prices from high to low are expanding, and the closes are getting higher. There's higher closes. So that tends to indicate that buyers think the price is going to keep going higher, is the idea that the price is going to keep higher. If the range is expanding, but the closes are getting lower, the price is getting lower, then sellers are getting a little bit more anxious and maybe wanting to unload that stock. Thus, the closes are getting lower. So you look at that expanding range in both a high or a lower close aspect. By the same token, you can look at a contracting range in high and low. So in a contracting range, they're getting narrower, not as big a width between the low and the high, but there is higher closes in this contracting range. Then it might be indicating that investors are feeling uneasy about the direction the security has been trending, and the higher close can offset some of that negative sentiment of the contracting range. So there might be a little unease. The range is contracting, but there might not be necessarily a reversal. They're kind of offsetting a little bit here. If the range is contracting and the closes are lower, well, that's kind of like a double negative for an existing trend. Traders are selling at a lower close, so they're willing to take lower prices, and also the range is contracting as well too. So maybe they're really just trying to unload the security and kind of get out of it, right? So, so that's an example. These are examples where high volume and lower close in a contracting range, as an example, and you combine the two, that can be a real big sell confirmation, right? High volume, it indicates that there's a lot more strength to whichever way the direction is headed. Lower close and contracting range shows that prices are going down. So combining them all together could be an example of a real pricing, big sell-off in terms of price on that. So there are some additional things to look for when you're looking at like prices and ranges and what might be happening, whether they're expanding, contracting with volume, and what might be going with an expanding range and higher closes or lower closes. Looking at all those things together, in addition to the other tools that we're going to then kind of layer on top of that. A trading range can also give you a feel for anticipated price gains and price losses in terms of, like, let's say, your own profits from trading in this particular security. And you can think of the terms of the range in terms of amounts. What is the difference between them? So if we use, let's say, on day one, something had a high of, well, we'll use dollars as an example, $10, and had a low of $8 using absolute terms, well, we would say it would have a $2 trading range, right? 10 minus 8, for example, very simple. So that will give you an idea of potential profit around there. So if we look at this, an example even closer, let's say over 5 days, you have these different price trading ranges. Now, these are not the actual prices. This is the range. Like the previous example showed us, we had a $2 range. Maybe day 2 was $3, and then $1 and $4 and $2. So over 5 days, you have this total ranges of, in effect, $12, and you divide that by the 5 days, you get your average daily trading range of $2.40, right? Simple math at that point. Again, not prices in this example. We're looking at the trading range as a technical indicator and maybe as a profit anticipator. So we have $2.40. So let's say over that daily range, that $2.40, then if you had bought at the absolute low in this particular example over that days of trading, and you sold at the absolute high, then you would have made $2.40 per share of security that you had for that particular day, or during that particular series. Now, is it common to buy at the absolute low and sell at the absolute high? No, not at all. But you might be near each of those extremes as far as getting that, and you can get a feel for what are your potential profits. So something that might have a high range and you're buying maybe near the low, and it has a high absolute trading range, you might have more opportunity for profit than something that's at a lower or more narrower range. So it kind of gets into the volatility of a security as well too. But you kind of anticipate things with higher ranges might give you more opportunities, but you have to look at so many other things as well too. But trading range can give you an idea of a lot of things you can look at from a technical analysis standpoint. So the open, high, low, close price bar is the foundational price bar, but there's different ways you can look at price graphically and visually as well too. And I'm going to show you some examples of that, and you might use different types of price bars that you can tell on your platform to basically reflect the chart the way you want it to look. You're the painter of the canvas, so to speak, so you can make the chart look the way you want. That might be easier to interpret. And then some price bars are better than others too, and particularly things like candlestick price bars. We have a whole section coming up on that, and that's a real important section, understanding those price bars and those price bar patterns with candlesticks. So we're going to save that for that section. But here are some examples of some different ways that you can look at, price bars beyond just the open, high, low, close foundational price bar. One that's very common is the HLC bar, which should look pretty familiar. It's the high, low, and close bar. Is basically missing the O. It's missing the open, right? And if we look at the one on the left there, these are two examples, by the way, of high, low, close bars. And the one on the left is pretty obvious. You can see there's no tick mark on the left side of the vertical line. There's no indication of the open. There is an indication of the close, and that's the tick bar on the right, and the range, the high and the low, but no indication of the open. And that's why the reason for that is a lot of folks really aren't all that concerned for many cases around the opening. They're really fixating more on the closing price, giving more emphasis to that. So if you're like that, you can use and clean up the chart a little bit better. You can use an HLC or high, low, close. Sometimes you might see it represented like on the right, where they kind of put where it looks like there's a tick mark on the left, there essentially is, but it's a straight solid line across. And so to really make the close kind of stand out more, you can see there's no body or there's no left tick mark. It's just the same left and right. That can get a little confusing because it might tell you that the opening and the close were the same. But if you set it up as, and it's a high, low, close bar, you can use that type of look if you prefer that look, and just know that there's no openings being reflected in that at all. Now, when we look at candlesticks, you might see some candlestick patterns that actually look like these. So you have to kind of differentiate between the two, where the open and the close are at or near the same price. But in this example of HLC bars, there is no open. It's just another way we represent it. That's why particularly, in me personally, I like the way on the left because it's real clear to me. But if you like the way on the right, that's okay too, Other ways that you can represent price as well are things like an area chart, for example, where you're looking at, things like, how does it look in terms of pricing things out and then having, kind of shaded underneath the price. So if you look at it, it almost looks like a mountain range, and you can see that it's, more kind of visual in terms of that aspect, but, it doesn't really clear out the lines, I think, as much as far as the prices. Doesn't really show you openings and closes. It's really just kind of showing you closes, and it kind of shows you some peaks and valleys. So that might be a way to look at, let's say, an area chart. Below that, you can see where it's just dots. It looks like it's a scatter diagram of dots, but it actually isn't. It actually is the closing prices just represented as dots. And you can kind of get a feel for where the lines might move from there, but that can seem a little more confusing to me, just as far as a personal opinion. On the bottom right, you'll see a real common chart, which is called a line chart. And you can see it's got black lines and red lines. Black would represent, in this case, that the finished higher, the high or the close was higher than the open, and red means it was a down day, that they closed lower than the open. So you can get a feel for open and close with the colors that way. And line charts can be helpful when we start looking at things like moving averages, and we're going to look at an indicator where you look at moving averages, and that's a line itself. And you want to look to see where that line crosses across, different price things. And sometimes line charts can be very helpful to see where that crossing point is. And then the one above that is another line chart, just using, dots basically to represent the pricing that way. So you can kind of choose the way that you like to see things represented. There's also price histograms, which are, bars going up and down. They're showing basically the price, and it would be at the top of the bar. It would be the high price or the closing price, depending on how you set it. But typically it's the closing price. And the black bar would be a positive day, and red bar would be that was a lower day. And you can kind of see, some direction things from that as far as a price histogram. Again, I don't like that. It doesn't show me a lot of information, but some things, histograms can be real effective. Like when we talk about the relative strength index, an indicator where you could use a histogram to make it, more easier to understand. And I will show you that so you don't have to worry about that. But typically what you're going to see are those open, high, low, close price bars, or high, low, close, depending on what you want. Maybe a line bar or a line bar, price bar to show where there might be a crossover. And then the real big one that you're going to probably use a lot and really see a lot are candlesticks. Here's a representation of candlesticks, and you can see they look like candles with a body and a wick at the top, some have a wick at the bottom. at both ends. So that's coming up, and that's a section you definitely want to really look closely at when we get into candlesticks, which is really in effect another form of price bar based again on the foundation of the open, high, low, and close price bars, but they can tell you a lot more and really are very, very helpful for technical analysis.